Hi everyone. In this video, I'm going to walk you through two important metrics, duration and convexity. Most importantly, how we can use these two tools to predict the potential impact on our fixed income bond portfolio resulting from interest rate changes. Before we even get to the calculation and the application of duration and convexity, let me walk you through a quick illustration about the non-linear relationship between the price of bonds, fixed income, and interest rates. Okay, I believe everyone should recall that we can get the price of a bond as the present value of all the future cash flows, and we can use the PV command in Excel to get that, where the rate is essentially going to be the yield, and we can then divide by 2, considering that these bonds are making semi-annual payments. Then these semi-annual payments are expected over 30 years, that is 66-month window. So we multiply this by 2. Every 6-month window, so I'm plugging everything in periodic basis. I am going to get a 4% of 1,000 divided by 2. That's not $40. That's on an annual basis. That's $20 every 6 months. My face value is 1,000, and then the type is 0. It means we are expecting cash flows at the end of each period, which is the conventional thing in finance. And if you forget that, Excel will plug the 0 for you because it's the default value. Okay, and then it's not surprisingly 1,000, which matches the face value. That is, we can say that this bond is trading at par. So you are buying and selling at the same price that if you look at the physical bond, it's stamped in the face in the fascia of the bond. Now, this usually happens in two periods, in two points. A bond trades at par at origination, because when you issue a bond, you're going to issue it at market conditions. That means you are paying a coupon rate that matches the market rate, the yield. And it also happens at maturity, because at redemption, at the time of redemption, now there are no more coupons left, and your bond essentially becomes a $1,000 quote unquote bill, right? So you have 1,000, but now what happens if the yields were not 4%, but we had 0% yields, or if we had 20% yields, right? So in order to do that, let's just redo these calculations for all these hypothetical scenarios with different yields, and then we can evaluate the full spectrum of where the price could be depending on how the yields are changing or what yields we have out there in the market. So we can use the PV command again, but now the yield is going to come from this A column, and we're going to explore all of possible yields or many yields divided by 2. And then every other parameter, we're going to take it from this box and we're going to lock it. So when I scroll down, these references are not going to change. Number of periods is this. I lock it, multiply by 2, 66-month windows. The payment is going to be the face value multiplied by the coupon rate. And before that, let me lock it, multiply by the coupon rate. And here I have to lock. This is something to pay attention to. It only added the dollar symbol before, so it's only locking the rows. So let me lock. This is payment, so it's going to be face value. We lock it. The $2 symbols are there, times the coupon rate. We lock that, divided by 2. And then the face value is 1,000. And then we lock it 2, and then comma 0. And there we go. And then we can simply scroll this down. And we can see, this is the most important point I wanted to make before moving forward, that this relationship is not linear. Now, we have heard a lot about duration, so let's predict this only using duration. And there's a limitation that will become apparent, and it will essentially make it very clear that we cannot just rely on duration, but we also need a convexity. Now, duration, and that there is another video covering the derivation of duration, which is or how we get to duration, which is the first derivative of bond prices with respect to yields. And then the convexity is just the second duration. So the first derivative by construction is capturing the linear relationship between the two, and we need the second derivative to get the full picture. Let's take a look at this quick example to illustrate this carefully. Now, the way in which we use modified duration, or the expression that gives us the predicted price change as captured by the modified duration, is negative modified duration times the rate. Let's add a space here. Negative modified duration times rate change, and then times initial bond price. Okay, there we go. And now that is giving us the expected dollar change, and then the updated bond price. It's going to be essentially the initial price plus the expected dollar change. Okay, now let's predict using duration first to see how this prediction looks like compared to the real deal. I mean, the blue line, we have calculated the price of the bond for each one of the yields one by one, with the entire calculation starting from scratch. Okay, so now let's assume that interest rates go down to 3% so there's a change of 100 basis points, they go down. So then what we would need is to use this formula, but now we need modified duration. We will calculate modified duration ourselves, but for now, for this exercise, let's use M duration so Excel can calculate this for us. We choose the settlement date, we choose the maturity date, we choose the coupon rate directly and on an annual basis. Then we will indicate the frequency. So Excel will do that transformation to 6-month windows. We don't need to do it ourselves in this specific command. Then we can also choose the annual yield. And now we specify that these are semi-annual. So Excel is going to convert those cash flows to semi-annual. And then we choose one actual. So we are going to use the actual number of days in order to calculate the present value. Okay, in a banking framework, sometimes the 3360 is used, but in finance, most of the time, we use actual number of days to get present value. So now we get the modified duration here is 17.38. One important thing is that the maturity is 30, and the modified duration and even the Macaulay duration is 17.38. This is telling us essentially, and another video would also explain more about that most of the price, most of this $1,000, right, are coming from the first 17.38 years of the life of the bond. Just to make it in a very simple, in a nutshell, to help understand this, think about the last coupon of this bond. It's $20, and you're expecting it 30 years from now. If you get the present value, the discounting, the 30-year discounting is so steep that those $20 become almost zero when you actually get the present value. So they have they're not meaningful as a percentage of the actual price of the bond. This is not contributing much to the price of a bond because the discounting is very steep, and it's essentially drawing those late cash flows close to nothing. Okay, so in other words, most of that $1,000 value, it is coming from the cash flows that you are receiving over the first 17 years. Of course, that's a weighted average. There's a big part of that $1,000 that is coming from redemption value. But when we take the weighted average, it essentially comes down to 17.38. Okay, so now let's work on the prediction here. If the yields change and go down by 1%, modified duration, we can choose this, and then we lock it, and then we multiply by the rate change, which is 1%. So I have prepared column B already, where it includes the change with respect relative to the initial 4%, which is our baseline scenario. And then I just multiply this by the initial bond price, and let me lock it here too. Okay. Now that is only going to give me the change. So if my bond, this is the bond that we have here in this table, this is this one. If rates go down by 1%, I would expect $173.8 increase in the price of a bond. So if I add that to the initial bond price, then I would end up with the revised price or updated price of 1,173.8. Now let's quickly scroll this up, and let's also scroll this down all the way here. And as you can see in the graph, then we're seeing this linear relationship here, downward sloping line, which is the prediction of the predicted bond price only using duration. But now you can clearly see that the blue line, which is, well, we have taken the time to calculate the bond one at a time, completely from scratch. So the blue line is not a prediction, it's the actual price. And we can see that the duration prediction is always understating this at the actual price, the fair price the bond should have, because the price, the bond price function is convex, has convexity, as long as your bond has convexity, positive convexity, which is most of the times the case. So in this case, we need to adjust and add the distance between the orange lines to the blue line. If we want to use duration, then we have to take the prediction from duration plus the prediction from convexity, and then we end up very close to the blue line, which is the actual bond price. Now, at this point, you may be thinking, but if the blue line is the real deal, and it gives me a very precise fair value of the bond, then why am I taking all this hassle of calculating things based on duration and then adding an adjustment of the convexity to get close to the blue line if I can quickly calculate the price of a bond using the blue line from start? Now, the thing is, what we have done here is possible for a single bond. But in real world, you may be dealing with a portfolio where you have hundreds of bonds. So then you would need to repeat this table and this table 100, maybe 200 times. To give you an example, US defined benefit pension funds, pension plans in the US, the duration of these bonds was estimated at 10.85 years. So once you have that number, you don't need to look at the holdings of every single defined benefit pension plan. Good luck with that. That would be a huge number of bonds, and then estimate their respective prices one at a time to evaluate the impact of rates on their holdings, on their fixed income holdings. We just need 10.85, and we can just do minus 10.85 times the minus 1% change in the rate times the initial value of their portfolio, and there we go. So it's a much faster, powerful measure, but it is an approximation. So now let's calculate this ourselves. What we are going to do is let's look at all of the cash flows a bond we are expecting from a given bond. To make this simpler, for simplicity, I have now changed to a 10-year to maturity bond, and we have it right here. And what we would like to evaluate is how is this bond changing? The price of this bond is changing if yields go up by 1%, which is what we have here. So in order to do that, we need modified duration. We can get modified duration using M duration in Excel, but we will calculate this ourselves this time. You may say, but if Excel has it, I don't need to calculate this, but you will have the benefit of Excel for modified duration and Macaulay duration, but we will also need convexity, and Excel doesn't have a built-in function to calculate convexity. So it's a good thing to acquaint with these calculations. And moreover, as you advance into more complex problems where credit spreads are changing or you have other dimensions to consider, having a strong knowledge on these calculations is going to make everything simpler. So let's get these calculations ourselves for the duration. So we will have the cash flows. We have the coupons, which is for a 10-year bond, every 6 months, we're going to have $1,000 face value times 4% coupon divided by 2. And now we just scroll this down. Okay, once we scroll this down, we go to the last value, the last 6-month window, and then we also add the redemption value. When we get to that last window, last period, we are also getting $1,000, which is the redemption of the value of the bond altogether. Now let's get the present value of each one of these cash flows, and we can continue to use the PV command. But this time we're only going to get the present value of one cash flow at a time. In order to avoid any confusion, let's just do it old school. So we can do 20 divided by 1 plus the yield divided by 2 to the power of time. Okay, that's exactly what the PV command is doing in this case. So we would log this yield, and then we don't want to log the period of the time period, and we don't want to log the cash flow. And then we just scroll this down. When we scroll this down, now if we add up all the present value of all these cash flows, that is the price of a bond right there. So that is exactly the same price. Let's get it here now using the PV command, but for both the face value and the coupons, we are going to use all the fields. So rate, we use the yield divided by 2. Number of periods is the number of years times 2. The payment is 1,000 times the coupon divided by 2. Face value is 1,000. And the type is always 0. Unless you have an unconventional cash flow or an unconventional instrument or security. Okay, now, so this 1,000, this is what Excel is doing internally. This is how we get the price of a bond. Okay, now for duration, we're going to weight each one of these cash flows by the time in which they occur. So we will do this times T. And then we're going to scroll down. I just need to do this. Okay, so we are giving more weight to the cash flows happening later on, and we're giving less weight to the cash flows happening earlier on. And then we're going to sum all of these weighted cash flows, and now we have a large number. Okay, and now here we can type T times present value of cash flow. Okay, there we go. And now the Macaulay duration, right? In a quote unquote, I'm going to call it a periodic way. It's very simple. After we have given all those weights coming from P, we just divide that large weighted number, the sum of the weighted cash flows, by the price of the bond. The denominator is the price of a bond, as we saw here. And then that would be the Macaulay duration on a periodic quote unquote basis. And I'm calling this periodic basis because then if we divide it by 2, then we are getting the Macaulay duration in years. Now we can use Excel to confirm that this calculation is actually correct by doing duration instead of M duration. Now this is only duration, and we plug all these values. Settlement is this, the maturity is this, the coupon rate analyzes this, the yield analyzes this. I'm not dividing by 2 or multiplying by 2 because now I'm going to specify that this is semi-annual. So Excel is going to do those adjustments for me. And then in finance, most of, if not all of the time, we use actual. And there we go. This is the exact same number. But now we take one last step to get the modified duration to account for the frequency of the cash flows. And we do it in the following way. We divide this Macaulay duration by 1 plus the yield divided by the frequency, M2, and that's it. Okay, and we can confirm that with M duration that we used earlier. We choose the settlement date here. We choose the maturity date here. We choose the coupon rate here. We choose the yield rate here, the frequency, and finally actual. And we can clearly see that this number and this number match. But now you can say that, well, I can do this myself. You know how Excel is getting those numbers. Okay, that is not particularly helpful for duration because you could use Excel, but it's going to be helpful because you're going to get convexity in a similar way. So convexity, you will take T times present value of cash flows, but you're going to multiply that by T plus 1 now. So that is not difficult. Now, before online, you may see something like present value of cash flows times T to the power of 2 plus T. Okay, now that and that is exactly the same. If you multiply T by T plus 1, you end up with T squared plus T. Now, the advantage of this form is, and that's why I'm using it here, is to just make the point that you take the values you just calculated to get duration, and you're going to multiply that now by T plus 1. So we use the values in column M, multiply by T plus 1, and that's it. We can now scroll down, okay, and then we add them up. Okay, now there's the similarity now between convexity and duration. So I'm going to call this raw convexity, periodic convexity, quote unquote. You're going to do the same thing we did for Macaulay duration. We divide this large number by the price of the bond. That's it. Now, since we are using semi-annual cash flows, let's quote unquote annualize them. Because convexity is the second derivative, things are changing a little. So now we cannot do this. The annual equivalent measure is not just what we would consider. This is the measure we should use. It would not be simply dividing by 2, but we would divide by M squared. So we would do this divided by 2 squared or by 4. And finally, the convexity itself, so we are just following almost the same, but instead of dividing by 2, now here we're dividing by 2 squared, so by 4. And now convexity, instead of dividing by 1 plus y, we're going to divide by 1 plus y squared. So we will take this divided by 1 plus this yield divided by 2 squared. And now that is the convexity measure. Now you can go online and find for a duration and convexity calculator. And if you do that, it should easily, you should be able to calculate convexity, and it's going to match this 78.89793 value. Okay, now you're an expert in calculating the modified duration, Macaulay duration, convexity. Now let's use them. Okay, so what I have done here is, let's assume this bond, now we are holding it and yields change from 4% to 5%, 1% hike. Okay, now what would be the price of the bond given this new yield? So we use the PV command, but now the yield is 5, not 4, divided by 2. Number of periods is 10 times 2. The payment is 1,000 times the coupon rate divided by 2. And the face value is 1,000 and type is 0. So now the price is 922. Okay, so that price change, it implies that my bond went down, the fixed income portfolio went down by 77.95. Okay, so it was $1,000. I bought it, yields went up by 1%. Now it is 922.05. Okay, so now what we are going to do, and here this is just like a modified duration. We already have modified duration here. Okay, now this is if we run this calculation manually. So we would take, if we have 200 bonds, then 200 bonds, all one at a time. We would then rerun their calculations one at a time and until we get the updated value of this portfolio. Okay, but if we have modified duration and convexity, we can use these measures to predict this change for us. Now, let's look at modified duration only, but we are already aware that we are getting this orange line. That is the prediction of modified duration. And then we will need to adjust the convexity adjustment in order to get a prediction that is closer to the blue line, the actual fair value of the bond, given the new rates. So the price dollar change predicted by modified duration. Now keep in mind that we are getting this multiplying minus MD times the rate change. Okay, and then times the initial bond price. Okay, let me move this actually like here. Okay, that is, and now let's use it. So we will have minus modified duration. Okay, times the rate change. So rates are going up by 100 basis points, 1%, times the initial price of the bond. And there we go. We have 81.76 drop predicted by modified duration. Okay, now what about convexity? So convexity, the adjustment would be a little different. It would be 0.5 times rate change, the change in the rate squared, times convexity times the initial bond price, the initial price of a bond. Let's move this a little bit here. So then move this on. Let's keep this one here. Okay, there we go. So that is the adjustment that we have to make to account for convexity. Keep in mind something, rate change here, it's squared. So if rates move down or up, this is always going to be a positive number. So this formula is always giving you a positive adjustment, and that is exactly what is going to take you from the orange line to the blue line. Okay, now needless to say, if we're moving from, let's assume you have a bond with zero convexity, then you're stuck with the orange line. But if you have positive convexity and rates move up, you're going to be better off the higher the convexity of your bond, because you're not going to be doing as bad as somebody with low or no convexity at all. But if rates go down, you're going to be better off compared to somebody with zero or low convexity, because convexity pushes the price of bond up. When rates go down and also when rates go up, you're always better off. So we want as much convexity as we can. That's something that we can try to maximize when we are forming a portfolio of fixed income. Now let's do the calculation here. It would be 0.5 times the rate change we are evaluating squared. So we're looking at the news. We presume rates may go up by 100 basis points. Then we're doing this adjustment. We calculate modified duration and convexity, not only for a single bond, but for the entire portfolio. We have hundreds of bonds, and then we can quickly use them to predict in a snap. And then multiply by rate, the change we expect in the rate squared times the convexity, which we have here, times the initial price of the bond, which is what we have here. And then this is the positive adjustment. So now when I consider both, this is the negative adjustment. This is the adjustment that we get from modified duration. And then this is the adjustment we get from convexity. When we add the two, things are bad, but they're slightly better. And now we get 77.81 as the price drop that is predicted when we consider both the duration and convexity. What we got here, 81.76 drop, is we ended up dropping to the orange line. And then the convexity is essentially pushing, it's like, no, no, wait, if your bond has convexity, you're going to be slightly better off. So now the convexity is pushing the prediction slightly higher. So it's going to get closer to the blue line, which is the actual, which is the price of a bond we actually calculated one by one. Okay, and then this is the drop predicted. It's still not perfect. It is the actual change if you do it manually, using all the values for this bond and calculating the bond from scratch. The drop you get is 77.95, and the price, the drop you get from this predicted value using duration and convexity, 77.81. So there is still 14 cents. There is a 14 cents difference here. Okay. Yes, this first derivative and second derivative, they would work almost as a perfect match if you look at infinitesimal changes. Okay, they are going to be fairly good predictors if you're looking at 100 basis points up or down. Now, if you evaluate this with a 4%, 5% change, then we would be in a very different situation, and duration and convexity may not be the best way to predict or to evaluate the impact on a bond portfolio. So if it's 25 basis points, 50 basis points, 1%, you're fine. You can predict the impact on your bond portfolio using a fairly accurate prediction using duration and convexity. But if you're expecting a 300 basis points, which is very unlikely, then duration and convexity are not likely the best way to go, because you're going to be further apart from the actual dynamics, from the actual relationship between bond prices and yields. So now I hope this helps. Bottom line is, if you have a portfolio of bonds, and the most complicated case is US defined benefit pension plans, you get the duration, it's 10.85 years. That is in recent literature, this number comes up from a research done by a Stanford academic. Then if you have this number, you can very quickly estimate the impact of rate changes in your bond portfolio without the need of looking at each bond one at a time. That is the powerful um, use, and that is why we end up relying so much on duration and convexity, because of how fast it allows us to evaluate this and to make decisions. Okay, and then I believe everything is fairly covered. Please let me know if you have any doubts or any questions, and otherwise, thanks for your attention. Let's keep in touch.